Right now, as you're watching this, something is happening in the gold market that has not happened since 1979, not 2008, not 2020, not during any crisis you actually lived through, since 1979. And while half the internet is screaming buy gold and the other half is screaming bubble, almost nobody is talking about the real reason this is happening, or what it means for your money specifically. Because this isn't actually a gold story, it's an oil story. And once you understand that, you'll see why the next domino isn't where anyone is currently looking. It's 90 miles off the coast of Florida. Stay with me through this video because by the end, you are going to understand something that most investors, even experienced ones, are completely missing right now. And that gap in understanding is either going to cost you or it's going to be the most important thing you learned this year. Here is the thing about gold that the financial media almost never explains correctly. Gold doesn't move because people are nervous. Gold moves because oil moves. Every single time in modern history when oil supply was threatened, gold surged. Every single time. And I don't mean sometimes, or usually. I mean without exception, going back 50 years. In 1973, OPEC weaponized oil against the West and cut supplies by 5% per month. Oil prices more than tripled, and gold went from $97 to $193 in 12 months. That's an 89% gain. Nobody told retail investors that was coming. The pattern showed it before the headlines did. And then in 1979, the Iranian Revolution hit. Oil supply shock, global panic, and gold went from $226 to $850 in 1 year. 276% in 1 year. That's not a slow appreciation, that's a vertical move. Then in 1991, the Gulf War pushed oil up 140%, and gold jumped 10% in just weeks. And in 2022, when Russia invaded Ukraine, gold broke through $2,000 for the first time in history. Every single time there's a serious threat to global oil supply, gold surges somewhere between 15% and 90% within 3 to 12 months. That is not a coincidence, that is a pattern. And right now, that pattern is setting up again in a way that looks more like 1979 than any other moment in the last 45 years. Why does that matter to you? Because gold is already up 48% from its breakout point in August 2025. Gold miners, which amplify gold's moves because their profit margins expand when gold prices rise, are up 140% from that same point. The money has been moving. The question is whether you understand why and what comes next. Now, let me explain the oil connection in a way that actually makes sense, because this is the part most people gloss over. Think about World War II. Rommel, the Desert Fox, was one of the most brilliant military commanders in history. He was crushing the Allies in North Africa. He was considered nearly unstoppable. And then he stopped. Not because the Allies outmaneuvered him, not because they outgunned him. He ran out of fuel at El Alamein. Just stopped. Allied bombers then systematically destroyed Germany's fuel production infrastructure. By 1945, German aviation fuel production had collapsed from 180,000 tons per month all the way down to 11,000 tons per month. They were still building aircraft. They just had no fuel to fly them. Think about what that means. The most advanced military technology in the world became worthless the moment the fuel was gone. Japan had the exact same problem. They attacked Pearl Harbor specifically because the United States had cut off their oil imports. They then invaded Southeast Asia, particularly Indonesia, to secure fuel supply lines. The moment those lines were cut, their entire war effort collapsed. No oil, no empire. That's the relationship. Oil isn't just an economic commodity. It is the single variable that determines whether any large system, military, industrial, economic, keeps functioning or stops cold. And that's why every time a major oil supply chain is threatened, capital floods into gold. Because gold is what people hold when they no longer trust that the normal economic system is going to keep running. Why does that matter to you? Because the Strait of Hormuz, the narrow waterway through which 20% of the entire world's oil supply flows, is currently under serious disruption risk. Iran says it's blockaded. The United States says it isn't. And Lloyd's of London, which is the institution that ensures the oil tankers that move that oil around the world, has canceled war coverage for ships passing through that region. Think about what that means. The world's most sophisticated insurance market, the institution that exists specifically to take on risk, looked at the Strait of Hormuz and said, not this one. When the people whose entire business is insuring risky things refuse to insure something, that tells you everything you need to know about how serious the risk actually is. Before I keep going, I want to pause for a second. Because everything I'm about to show you, the Cuba thesis, the sector breakdown, the historical pattern, is going to give you a framework for understanding what is happening right now in the world. But understanding the macro picture is different from knowing how to position your own money intelligently in your specific situation. If you have investments in a retirement account, a brokerage, a 401k, and you are watching what's unfolding in the Middle East and the Caribbean right now without a clear plan, I put together something that can help. Here at Finance Deciphered, we do deep research on exactly where institutional money is moving during periods like this, and how individual investors can think about positioning around it. The link is in the description. It's free. Now, let me show you the part of this story that virtually nobody in financial media is connecting yet. Everyone is focused on Iran right now, and they should be. The Strait of Hormuz situation is serious. But here's what happens when you follow the oil instead of the news. You start to see the next domino before it falls. And the next domino is Cuba. I want to be clear up front. I could be wrong about this. The timing is uncertain. What I'm presenting is a pattern, not a guarantee. But here is what the data is showing. Cuba gets the vast majority of its oil from Venezuela. That has been the deal for decades. Cheap Venezuelan crude in exchange for Cuban doctors, military advisors, and political support. It worked. It kept the Cuban economy functioning at a basic level. Then the United States significantly restricted Venezuelan oil exports. And what happened to Cuba? Fuel crisis, rolling blackouts across the entire island, not for hours, for days at a time. Hospitals running on backup generators. The economy contracting sharply. This is documented. It's been accelerating since late 2024. Now here is the geography that changes everything. Cuba sits 90 miles from the coast of Florida. 90 miles. That is less than the distance from New York City to Philadelphia. And Cuba sits directly on top of one of the most strategically important shipping lanes in the entire Western Hemisphere. Every tanker carrying oil into the Gulf of Mexico, every ship supplying energy to Houston, to New Orleans, to the entire southern United States energy infrastructure, passes near Cuban waters. This is not minor geography. This is the kind of geography that has determined the outcome of conflicts for centuries. And when you look at the pattern of how energy geography has been contested over the last 25 years, Iraq, Libya, Iran, Venezuela, you see a sequence. Venezuela is done. Iran is in progress. The next logical pressure point, if you follow the oil and not the news, is Cuba. Why does that matter to you? Because right now, shipping disruption risk in the Caribbean is rising. Insurance costs for tankers moving through Caribbean waters are increasing. Capital is beginning to move out of Caribbean-exposed assets. These are early signals, the kind that show up in money flows weeks before they show up in headlines. And if you've been paying attention to the historical pattern we've been discussing, you know that by the time Cuba makes the front page of every financial newspaper, the setup is already done. The people who understood it early are already positioned. The people who waited for confirmation are buying at the top. Now here is the problem you're facing right now, and I want to address it directly. Every conflict, every geopolitical crisis, every market disruption comes wrapped in what I call the fog of war. And in 2026, that fog is thicker than it has ever been, because social media amplifies every rumor, every prediction, every piece of deliberately misleading information at a speed that makes it almost impossible to separate signal from noise. Half the people in your feed are telling you to panic and sell everything. The other half are telling you to buy whatever they happen to already own. Neither of them is being paid to help you make good decisions. They are being paid to get your attention. So here's the framework that actually works, based on what the historical pattern consistently shows. First, don't watch the news. Watch the money. The news tells you what happened yesterday, or what someone wants you to believe happened yesterday. The money flows tell you what informed institutional capital, the people managing hundreds of billions of dollars, actually believes is going to happen. Before the Iran situation made headlines, institutional money was already flowing into gold ETFs. Gold moved in August 2025. The headlines caught up weeks later. If you were watching the money flows, you caught 48% of the move. If you were waiting for news confirmation, you missed most of it. Second, ignore predictions, including this one. Nobody knows with certainty what is going to happen tomorrow. What I can show you is where the money is moving right now and what the historical pattern suggests about where it tends to go from here. That is very different from a prediction. It is pattern recognition. And the difference between the two is the difference between gambling and investing. Third, when a headline makes you want to do something immediately, pause. The urgency you feel in those moments is almost never justified by the actual situation. The investors who built real wealth through every crisis of the last 50 years did not do it by reacting to headlines. They did it by understanding the underlying pattern, positioning accordingly, and staying disciplined when everyone around them was losing their nerve. Why does that matter to you? Because discipline is the actual edge. Not information, not intelligence, not connections. The ability to look at a chaotic situation, identify the pattern underneath it, and act on the pattern rather than the panic. That is what separates the outcomes. Now I want to give you the part of this that most people in financial media skip because it doesn't make for exciting content. The honest calibration. Here is what could be wrong about everything I just said. The 1979 parallel is compelling. But the situation today is not identical to 1979 in one important way. The United States is now the world's largest oil exporter. That changes the shock dynamic significantly. In 1979, an oil supply disruption hit the U.S. as a pure consumer. Today, a disruption in the Strait of Hormuz would actually benefit U.S. oil producers while hurting other global consumers. So the scale of the gold move, if it comes, may be more moderate than 1979. Something closer to what we saw in 2008, when gold still gained 17% over 3 years even without a dramatic supply shock, is more realistic than a 276% replay. That is still a significant move, but it is not the vertical spike of 1979. On Cuba, specifically, I could be entirely wrong. The pattern suggests Cuba is a likely next pressure point. The geography supports it. The energy vulnerability supports it. But geopolitics doesn't follow a script. There are dozens of variables I can't see from here. What I'm presenting is a probability framework, not a certainty. And any investment decision you make should account for the fact that the pattern could break. This isn't financial advice. I'm not a registered financial advisor. Investing involves real risk. You can lose money. Never invest more than you're willing to lose. What I'm giving you is a framework for thinking, not a prescription for acting. With that clearly stated, let me walk you through how the historically informed investor thinks about sector positioning during a period like this. Because knowledge without a framework for action is just entertainment. Gold and gold miners. Gold is the anchor position in an oil shock environment. That is what 50 years of data shows. Gold miners amplify the move because when gold prices rise, miners' revenue goes up while their costs stay relatively fixed. The math gets very good very quickly. Gold miners are already up 140% from the August 2025 breakout. That doesn't mean the move is over. In the 1979 cycle, miners continued running long after the initial breakout, silver. This is the one that most people overlook entirely. In 1979, silver outperformed gold 3-1, and right now the physical silver market is showing serious stress. The COMEX, which is the exchange where paper silver trades, is running low on physical inventory. And when paper markets lose control of physical supply, prices tend to move in ways that surprise almost everyone. Add to that the fact that silver has enormous industrial demand. It's in every modern weapon system, every drone, every guided munition, every piece of defense electronics. And you have a supply-demand picture that is tightening from multiple directions simultaneously. Energy majors, companies like Exxon and Chevron, and the XLE ETF that tracks the sector. Supply disruptions are historically very good for energy producers because their existing production becomes more valuable when global supply tightens. After the Gulf War in 1991, energy stocks went up 34% over the following 18 months. When oil supply is under pressure, the companies that produce oil benefit directly: defense and aerospace. This sector has a near-perfect track record of outperforming during sustained geopolitical instability. After September 11th, defense outperformed the S&P 500 by 47% over the following 3 years. Governments don't cut military budgets during instability. They accelerate spending every single time, regardless of political party or ideology. The ITA ETF tracks this sector broadly. And finally, utilities. This is the boring one that nobody wants to talk about, and that's exactly why it belongs in a crisis portfolio. Utilities are domestic. They pay stable dividends, and they are almost entirely insulated from what happens in the Strait of Hormuz, or 90 miles off the Florida coast. When investors get seriously scared, money flows into boring dividend-paying assets. Utilities peak in the absorption phase of every geopolitical crisis. Now let me show you the 4-phase pattern that has appeared in every major geopolitical crisis of the last 50 years. Because understanding where we are in the cycle is as important as understanding what sectors to watch. Phase 1 is shock. This is where we are right now. Oil and gold spike. Equity markets drop. Headlines scream. Retail investors panic and either sell everything or freeze completely. To the narrative at this point is always that things are going to get worse, that this time is different, that the normal rules don't apply. They do apply. They always apply. Phase 2 is absorption. This is where the initial panic begins to subside and the market starts to digest the new reality. Safe haven assets, gold, energy stocks, utilities, often peak here. And this is the most dangerous phase for retail investors because it's the moment when most of them finally decide they can't take any more pain and they sell. They've absorbed a 10%, 15%, 20% drawdown, and then right at the point of maximum pessimism, they exit, selling at the exact moment the smart money is beginning to accumulate. Phase 3 is recovery, typically 4 to 18 months into the crisis, depending on how it resolves. Growth stocks start outperforming again, the broad market begins recovering, and the retail investors who sold in Phase 2 are still sitting in cash or safe havens, watching the recovery happen without them. because they sold the bottom and now they don't know when it's safe to get back in. And they keep waiting until the recovery feels obvious, which is usually when it's already priced in. Phase 4 is outperformance. New all-time highs. After 1979, new highs. After 2001, new highs. After 2008, new highs. After 2020 and 2022, new highs every single time. Why does that matter to you? Because the pattern is not about predicting which asset goes up or when the crisis ends. It's about understanding that the cycle always completes and positioning yourself so that you're still in the game when it does, rather than having sold at the worst possible moment because the headlines scared you out. Here's what I think the truly unthinkable thing is about this moment. And it's not what the title of this video suggested. It's not that gold is doing what it's doing. But the pattern is clear. It's not that Cuba might be the next flashpoint. The signals are there for anyone who follows the money rather than the news. The truly unthinkable thing is that most people are going to watch a video exactly like this one, understand everything being explained, feel the clarity of the framework, and then open their social media feed 5 minutes later, read 3 panic-inducing headlines, and make exactly the emotional decision that this entire video was designed to help them avoid. I understand why that happens. Nobody taught us this. The financial education that actually explains how geopolitical events connect to market movements, how oil flows translate into gold cycles, how to read a crisis as a pattern rather than a catastrophe, that kind of education is genuinely rare. And in some corners of the financial industry, the confusion that results from its absence is quite profitable. But here's what I know about the person still watching right now. You didn't click away during the history lesson. You stayed through the Cuba thesis and the honest calibration about what could be wrong. You're not looking for someone to confirm what you already believe. You're looking for a framework that actually holds up when the world gets complicated. And that is a fundamentally different relationship with information than most people have. It doesn't guarantee you'll make the right calls. Nothing does. But it means you're asking the right questions. And that is the only real edge that consistently compounds over time. If this video gave you something useful, the most valuable thing you can do is share it with one person in your life who is making financial decisions right now based purely on fear or hype. Someone watching their retirement account and not understanding why it's moving the way it is. Someone who needs a pattern to hold on to instead of just noise. The link to go deeper on this research is in the description. I'll see you in the next one.